Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy.
Good morning, everybody. As it's the end of the quarter, we're going to do things slightly differently as we tend to do. So Piers will go first, and then I will follow on from him. But without further ado, I'm going to hand over to Piers to present the technical outlook now that the quarter is finished. So Piers, over to you.
Thank you very much, Neil. Right, just to say, I look at things simply looking at price. Why do I do that? I think a lot of people are under the misconception, I feel, that market events are random, driven solely by sort of fundamental laws and news, meaning that market turns and stalls can't be timed or predicted. Now, from my 40 years of studying the markets, charts tell us otherwise, I feel. Charts were around before modern day economics, just not as widely publicised. So, for me, markets are driven by mathematical order and history, and it's usually the same sort of patterns, retracements and cycles that happen time after time. So hopefully this presentation will help you see that now. So if we go to the first slide, it's the dollar index chart. So the dollar rules the market. So we need to know what the dollar's doing in order to know what everything else is going to do. So on this, it's a chart we looked at many times on the quarterly chart. The 38.2% retracement of the high going back to 1984 to the low in 2008 is around the 106 area. So 106.60 is the exact area. So that's the 38.2%. It has capped price for the last few quarters. What's holding price is the 20-period moving average underneath it, which comes in about 99.63. So while price is above 99, this uptrend is intact quite nicely on the quarterly chart. So I think it's going to be a matter of time before that 38.2% gets tested again. If that 38.2% breaks the 106 area, then I think we see a move higher. But on this chart, what we're trying to show is that you have higher highs and higher lows, the retracement stopping at the 38.2. That's the area you need to get above to see dollar strength. Below 99, you can start to think that that dollar strength might not be coming. But if we go to the next chart, I zoom in, and here we look at closer price action. And if you look at this, we can see that price broke a downtrend line going back. So it broke through that a couple of years ago. It rallied up, and then it's fallen back down. Now we have something called the rule of polarity. So the old highs of 2019, 2020, they've acted as support in 2023, 2024. So that's the rule of polarity. So again, it's that same area, 99, 100 area, like the 20-period moving average on the other chart. So that's a very significant area. Now, as we go up, say we break that 106, where's the next upside? The next real resistance is going to be the 109, 111 area. And that's the area it needs to break to get that confirmation of another strong leg higher in the big picture. So remember this webinar, we're looking at the very big picture. These are quarterly charts. We're looking at what will happen in the big picture. Shorter term, you can get my weekly charts, my daily charts. I sent out a monthly chart yesterday. So at the moment, 99, 100 support, 106 pivot, above 106 goes up, 109, 111. That's how I see the dollar at the moment, dollar index. So we go to the next slide. The next slide, we have euro dollar. And on this slide, it just goes to show how simple markets can be. I've said it's like a mathematical, patterns repeating themselves. This is good evidence of it. So you have a simple downtrend, a simple uptrend from the year 2000. All those red circles, every time price hit that trend line, it rallied. But then suddenly something happened. When it came back down in 2022 to the trend line, it broke. So it broke below. We know the rule of polarity. Old support becomes resistance. Price then tested back up, and we saw price test back up to it last year, and it failed underneath that blue arrow, right on that trend line. And that's where euro dollar fell off. So we didn't look at interest rates, inflation numbers. We didn't worry about politics, wars. I'm sure there's lots of people who don't really understand charts who will tell me all the reasons why it bounced each time off that trend line and why it got sold off exactly at that trend line. But we don't need to know those reasons. Just simple rules we'll follow. So price is falling off that trend line. If you want euro dollar stronger, you need euro dollar to reclaim and get above that trend line. While it's below that trend line, there's a risk it does fall down a bit lower. So that's what I'm going to watch, the trend line. But let's look at some other things in here. So let's go to the next slide. And let's put a bit of mathematical order on, because that's all we know, that's all the market is. It is just mathematical order all the way through. So the trend line's still there, but on top, we put Bollinger Bands and the Fibonacci retracements. So on the last charts we did, quarterly charts, euro dollar was 110, and that was back in January. And I had this chart to show that mathematical order, and I said, probably see a fall back down towards the 105, 106 area. Why was that? We had the trend line. You've also got the 23.6%. So it's been held for the last 5 quarters by that 23.6%. So that's over a year, one level has capped euro dollar, the 23.6%. So while you're below that and the 20 period moving average, about the same area, and that trend line, that's why the market's falling off at this stage. If, as I said before, if you want euro dollar higher and you want signs of it, you need it above that 23.6. You need it above that sort of 110.30 area. Now, where is support? Well, let's just put in the 38.2% of that move back up, and that's 106.12. If euro dollar starts to get below 106, then you have to worry, if you want euro dollar higher, you have to worry that actually it might be going back lower. So I'd watch the 104, 106 area as a buffer zone. Below that, this is just a continuation of a downtrend. Simple as that. Now we'll go to the next chart. Now this is my favorite chart of the last 7 years. If you're going to look at a market that has been simply controlled by mathematical order, the last 7 to 8 years, it's sterling. It's been very simple. For 5 years, if you'd sold sterling at one simple level, you'd have been happy by the end of that quarter. Then last year, that level broke and price broke higher. You may remember I sent out an email when that was happening, warning people we're breaking through that. The rule of polarity meant it simply switched, and that it did. And so since the break, for the last 3 quarters, so for 9 months, it has been the low in sterling and given you a great opportunity each quarter as the best place to buy sterling. So for 7 or 8 years, we've had 4 prime ministers, 1 general election. We've left the EU, had 18 UK base rate changes. However, just one level, that 38.2%, has ruled the value of sterling. So you had a very good rally off it this quarter, very strong. We've gone all the way up to the 50%. So when it broke last year, we went 38.2%, went to the 50%, fell back to the 38.2%, back up to the 52, back up to the 50%. How mathematical is that? I mean, there's been loads of fundamental stuff going on. I'm sure the economists have plenty to say about sterling over that time, but it's all in the price. So the highest quarterly close since Brexit, the highest quarterly positive close since Brexit last quarter. So you'd hope to see some move up towards the 61.8%, but we need to break away from this 50% first. So if we can start to clear this 50%, then I think we go up to the 61.8% area of 69. But I expect 69 and 70 area to be a strong resistance for sterling. Now, the 70, you might remember, came from the yearly chart we did the other month. So where's support? We know where the resistance is. Support is that 38.2% and the 20 period moving average. So it's 64.65. If the sterling index starts to go below 64.65, then you know something's changing on sterling. sterling's lost all its friends it's had. It's had a really good rally in the last 2 years. But below 64.65 is where I start to think something's going wrong with that rally. So keep watching the monthly webinars and I'll keep you updated on sterling. So the next chart we have is Euro Sterling quarterly chart, which has a nice uptrend, and it looks like that. We closed right on the uptrend last quarter. We're opening slightly below it. The reason I'm showing you this before going to sterling euros, because on Euro Sterling, which is the traded item here, it closed on the trend line. It hasn't yet confirmed to break that trend line to the downside. But if we go to sterling euro, which Neil tells me everyone prefers, you'll see that the data is always slightly different. It's very annoying for this. But it looks like that trend line broke last quarter. So you have got a break of the trend line. Now, that's going to be positive for sterling. But we have to sort of bear in mind on euro sterling, it hasn't quite broken. So I'd like to see a bit of confirmation this quarter. So initial resistance, I think, in sterling euro is around 117.20.30, followed by, if it gets above there, up to the 118.15.20 area. If it gets above 118.15.20, then you're probably opening up the 38.2% in the 120.121 area. So that 121.5 should be probably tough resistance if it gets up there, because that's 38.2%. Where should support be? Support should be in the 115.25 area. And if it got below there, I'd start to worry if it got below 114.25.30. A quarterly close below 111.60 is where the whole positive feel's gone, and it's gone back into negative mode. Now, I've gone slightly wider with my ranges on this than I normally would, because at some stage, an election's going to get called for the UK, and markets don't like uncertainty. So I think when it's called, although maybe the expected result is already factored in the price, you might get a bit of a knee-jerk reaction. So I would watch the trend line this quarter and those levels. So what I'd like to watch as the quarter goes on is, how are we in relation to that trend line? Are we moving away higher? Is it a good break, or is it coming back down, a false break? But that's something I'll keep you posted on the daily, etc., daily, weekly charts. So the next chart we have is sterling dollar. This is the chart from last month. And last month I said, in order to progress higher into the 130s, sterling dollar had two conditions it had to meet. One was a weekly close above 128.75 and a monthly close above 127.55 was the second one. We saw test up into the high 128s, but it failed. Where did it fail? At the base of the Ichimoku cloud. It didn't actually get a weekly close above 128.75. It then fell back to close the month below the 127.55. So it didn't manage either of those two things, and that's why it didn't go to the 230s. Two things it had to do, failed both. As it failed both, what did it do? It fell down quite badly. It stopped at the 61.8%. It stopped at the downtrend line, which we talked about last month. So very mathematical again. So resistance on the monthly chart remains at 127.55.75 with 128.75 above that. Support should be in the 125.25 area initially on the monthly chart. Below that, 124.10 would come into play. But one thing I'm just going to show you is when it turned. So on the next chart we have here, this is the daily chart. This is the chart I send out each day. But you had a lovely symbol. When the price failed around that 128.75, 128.95 area, price failed, it came back, it gave you a harami candle, which is, it's supposed to be it's the red body is completely within the green body after an uptrend. So it's giving birth. That's supposed to be the baby within the mother. The mother is the green candle. The baby is the little red candle. The baby always goes in the opposite direction. I put that on my daily charts, harami candle, change of direction, look at the move down that came. But the one thing I just want to say is that's how you use these charts and these webinars. So use the webinars for big levels, and the daily charts can help you in between. But look what a mathematical order it's been down. Look at the retracements down. It's just worked its way down those retracements using each one as support and resistance. I mean, in the middle of that, you had a central bank announcement from the Fed, but it still worked down those Fibonacci retracements quite nicely. Anyway, we'll go to the quarterly chart on the next slide. Right, so this is the quarterly chart, big picture. Again, another great example of how mathematical FX markets are. You know, people will tell you tons of reasons why everything happens. But look at these retracements. They just work time after time after time. It is that simple. Don't be fooled that it's more complicated. So what have we got? We've got the retracements to watch. The initial retracement comes in at 23.6 at 129. So while you're below 129 on a quarterly candle, price is capped. You're going to get a bit of a fall off. If you get above 129 on a quarterly close, then you start to look for higher sterling dollar. You know, I would think above 129, you could see maybe 133, and above 133.30 is where you really start to get some takeoff, I feel. But at the moment, you're capped by that 129. How long has it capped sterling dollar for? It's capped it for 1, 2, 3, 4 quarters. So for a year, if you just looked at that simple retracement, you knew where the high was going to be, the resistance. Now, where is support? So if I look at support here, I think that you could probably see support in the 24, 25 area. Now, that's going to be key support. If it breaks that 24, 25, is going to be significant. But the strongest support is down in the 120, 70, 75 area. That's the 38.2% of the rally since 2022. And that would be a key area if price did get down there to watch. But at the moment, I just sort of think you might be in a 125, so 124, 125, 130, 129, 130 sort of range. Keep an eye on that. Resistance up there, the support down at the bottom. Keep watching the daily charts. You know, I expect there to be some turbulence in the markets over the latter part of this month. So I think, you know, keep an eye on the markets towards the end of this month. I think some turbulence arrives and maybe be ready for that. I'll cover that on my daily charts on next month's webinar if it happens. Which, yeah, there we go, which disclaims me from everything I've just said. But I'll pass you over to Neil now.
In terms of my presentation, very quick, 4 slides, just focusing on growth, interest rates, inflation, and FX forecast, followed by my disclaimer. And I'm going to plow straight into this in terms of what have we seen, what's been a sort of change that we've seen over recent months. And this is the chart on the left here is manufacturing PMIs for Euroland, the UK, and the US. And there has been a recent improvement. So we've gone to so if we look at what we were talking about previously with regard to growth, growth was disappointing. Growth forecasts have been disappointing. But there are some signs from these manufacturing PMIs and also some of the numbers that we're getting out of services as well, that perhaps the trough has been reached as far as economic activity is concerned, and we might start to see an improvement. Now, there are some clear warning signs, however, one of which is that those geopolitical risks that we've spoken about numerous times on these calls have not gone away, although they appear to, as yet, not have had a lasting negative effect. So perhaps we're getting used to issues around the Red Sea and delays as far as shipping and transportation are concerned. We are now into the 3rd year of the Ukraine-Russia conflict. And so the problems around sunflowers, problems around wheat, oil, energy generally, and a number of other commodities have perhaps, we've seen the worst of those issues as well. We still fear an escalation in tensions between China, Taiwan, and the US. But as yet, we haven't seen that either. And so from the perspective of those geopolitical risks that Piers has already mentioned, doesn't seem as if they are having the negative effect that perhaps some expected. But one thing I would highlight that I still don't believe we've seen the full impact of is the higher interest rates. And interest rates have been drifting higher again. So markets have been pricing out the prospect of interest rate cuts from all of the major economies, particularly from the US, though. And one other thing that I would highlight is that when we go and speak to businesses around the country, some businesses are saying, yes, they've seen an improvement in economic conditions, in order books, and such like. Others, however, are saying, no, we haven't seen anything. And particularly in areas like retail, mid-range is really struggling for retail, budget is doing well. So that would still suggest that there's a cost of living issue that's ongoing as far as not only the UK, but I think this is something that's widespread around the Western economies, so North American and also Western European. So we move on to the next slide, and I actually focus in on interest rates. I said last time that I thought we were in a bit of a holding pattern, and that holding pattern persists. But it might be a prolonged holding pattern from the US after the number of the survey that we've had out recently, and some of the official data, official activity data, would appear to indicate that the US economy isn't slowing at the pace that we might have anticipated. There are still problems in US commercial real estate. There are still problems across some of the regional banking sector. And we have seen a drop away in terms of inflation pressures. But notably, I think the Federal Reserve will be concerned by the ongoing heat that they're seeing from the US labor market. And as I say, some of those surveys that appear to show renewed signs of strength. So the US might end up being the last to cut interest rates of the three major economies, or at least cutting interest rates in conjunction with the Bank of England into the second half of 2024, whereas the European Central Bank still appear to be wedded to cutting interest rates before the European Central Bank break for their summer recess. So that would be either their July meeting or their June meeting. It looks highly unlikely it will be their April meeting. It's too early for that. And consequently, they would be kicking the rate cutting cycle off as far as those major Western central banks are concerned. You know, could that have a negative effect on the euro, or is it already priced in? And are markets now pricing in too few rate cuts from the likes of the US and perhaps also the UK versus where we were only a few weeks ago? How will that play out in terms of the currency markets? I think macroeconomically, if you look at this, then there is definitely a more powerful case to argue for both the UK and the Euroland economies to have interest rate cuts, whereas there's a less powerful case for the US. But if we look at the inflation outlook, which is the next slide, then you can see that inflation has fallen quite dramatically. And look at how much the UK has closed the gap in terms of headline consumer price inflation versus the US and Euroland. So there is now no longer the same argument that some members of the Monetary Policy Committee were making, that the Bank of England ought to be the one that went last. In fact, I think when we get sort of a couple of months further into this year, we may well see UK inflation rate actually dipping beneath the US and Eurozone inflation measures. So it'll be interesting to see whether or not that will compel the Bank of England to move either faster or cut by more into the second half of 2024. For Euroland, we've seen further improvement in headline and core inflation measures as well. We're getting very, very close now to the point at which they're basically at target and ought to be considering interest rate cuts, and not just one or two, but a series of interest rate cuts in order to ease the pain on economic activity. One thing that, again, potentially delays a US rate cut was that the preferred measure of US inflation for the Federal Reserve, that's the private consumption expenditure deflator, remains stubbornly above 2%. It actually ticked back up from 2.4 to 2.5% in the latest number. And I think that is perhaps playing on the minds of some members of the Federal Reserve. So we'll just wait and see how that materializes, how that develops over the course of the coming months or so. But another factor to piece into this is that China has seen material price weakness, and I think they are struggling, even though some of their data appears to be showing signs of improvement. They are struggling to maintain growth rates at the levels that authorities would like to see them at. And consequently, I think that could feed into weaker price inflation globally. China might try to grab a larger market share. And we have seen additional Chinese currency weakness over the course of the last month. So if I then look at the next slide, look at what this means for our FX forecast, well, they haven't really changed that much. But I would pull out the fact that in terms of the expected weakening in the US dollar that we had, we've now pushed that out a little bit. The expected weakening in the US dollar against the Japanese yen, we've materially pushed that out. Although we still have a much stronger Japanese yen. We think that the Japanese authorities have muddied the waters here because ultimately they said on the one hand that they were prepared to end the zero rate policy, but on the other hand that if the yield curve got out of control, then they would intervene in order to stabilize yields, to prevent yields from climbing too high. So I think they've made the job for them a lot harder in terms of bringing down inflation, certainly from an imports perspective, because the yen remains weak. In fact, it's trading today close to 152 again, and those are levels where we've seen Bank of Japan intervention in the past. I think if the Fed are last to cut interest rates and look reluctant to make big interest rate cuts, then we could see some dollar strength going into the sort of next few months of the second quarter, potentially even into the second half of the year. So delaying any US dollar weakness. But those things I mentioned about the problems around credit, commercial real estate and regional banks may well come back as greater problems in the second half of 2024. And I think that could be the reason why the Federal Reserve end up by cutting interest rates rather by more than is currently priced for by the markets. They have fewer than 75 basis points worth of interest rate cuts from the Fed for the whole of 2024, or what's left of it at least. And I think that might be light when we reconsider all of the macroeconomic conditions. So that's my very brief, quick run through of everything. There's my disclaimer.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.